단쉐lermbookie. Welcome back to the deep dive. Today we're offering a kind of high-speed shortcut through some really critical issues that are all over the front pages of the Seoul Economic Daily. We're looking at, well, a mix of economic friction, a huge lawsuit, and some major new policy moves.
That's right. And what's so interesting is this tension between, immediate market fear on one hand and these big long-term structural reforms on the other. We're going to connect the dots between the market volatility, this high interest rate, high exchange rate double trap, and then a major lawsuit against the delivery platform, Daol Investment.
And then we'll cap it off with some surprisingly fast-moving developments in capital markets and even up near the border.
Exactly.
So let's jump straight in because these financial pressures are happening right now. Let's start with that double trap, or G. This is the relentless pressure from high interest rates and a soaring exchange rate. The market seems to be reacting very strongly to recent comments from Korea Governor Lee Chang-yong.
Well, absolutely. It's fascinating how the markets just picked apart his statements to BloombergTV. He said that the timing and size of any future policy switch, a move toward rate cuts, would be completely dependent on new data.
Okay, that sounds standard enough.
It does, but here's the kicker. He then added that there's a real possibility of an upward adjustment to the nation's growth forecast.
And right there, that's the hawkish signal the market heard, isn't it? Better growth means inflation worries stick around, so the BOK has to keep rates high for longer.
Precisely. That was the confirmation they needed. And it sent these immediate shockwaves through the national Treasury bond market. We saw bond yields move like crazy.
How much are we talking?
The 3-year yield jumped 0.092 percentage points. The 5-year yield shot up a full 0.1 percentage point.
In a single day.
In a single trading session. Those are massive, massive moves. It really reflects this new realization that the rate cut cycle everyone was hoping for might be over before it even really started.
And if you zoom out a bit, the monthly trend is just as stark. The 5-year yield is up 0.411 percentage points over the last month. The BOK is just trapped, it seems. They can't cut rates because of real estate prices.
Which leads right into the second part of that trap.
The currency risk.
Exactly. The $1 exchange rate recently touched 14.70. That's a level that makes the central bank extremely nervous. So Governor Lee's hints about maybe intervening in the market, that just confirms how seriously they're taking it. They have to prioritize a stable exchange rate, and that means a rate freeze is the most likely path forward.
So high domestic asset prices are forcing their hand on interest rates, and a weak currency is doing the exact same thing. Is this just a temporary blip, or is this the new normal for a while?
Most experts are really framing this as a structural shift, not a temporary thing. Daol Investment Securities, for example, they're forecasting NTB yields could climb another 0.15 percentage points by the year's end.
And the exchange rate?
Well, with things like the U.S. government shutdown getting resolved and the Japanese yen staying weak, we could easily see the rate push toward 1480, maybe even 1490.
And I saw Professor Lee Chang-yong actually called this a structural flow. He's saying it's not just market noise.
Yes, and that's the key takeaway. It's a fundamental shift that businesses and consumers now have to plan around. It creates a really tough environment for investment.
Which is a perfect transition, actually, because that kind of broad economic friction, it always shows up in specific business disputes.
It really does.
So let's shift from that macro stress to a really specific legal battle over platform governance. This collective lawsuit against Woo-ah Brothers, the company that runs Daol Investment or Bayman. This gets to the very heart of what a platform is selling, right?
It does. This is a big group of franchise store owners.
Yeah.
And their complaint is all about how Bayman calculates its brokerage commission. That's the fee between 2 and 7.8%. They're arguing that Bayman was basing that commission on the pre-discount price.
So on the full sticker price, even if a customer used a coupon and paid less.
Exactly. Can I give you a quick example?
Please do.
Okay, so say you have an item that costs 24,001. The customer uses a 4,001 coupon, so the restaurant owner only gets 20,001. But the lawsuit alleges that Bayman was charging its commission on the full 24,001. So the owner is out the 4,001 from the coupon, and they're paying a commission on money they never even saw.
Wow. Okay, that sounds pretty unfair on its face. What's the legal argument they're making?
The law firm, YK, is arguing 2 main points. First, that it's a simple breach of contract, which they say requires the fee to be based on the final post-discount price. And second, maybe more powerfully, they're arguing it's what's called unjust enrichment under civil law.
And this law firm has a history with this kind of case, right?
They do. And that's what makes this so significant. This is the same legal team that won a massive 21 billion won refund ruling against Korea Pizza Hut in a very similar dispute. They know how to take on these big platform companies.
So given that track record, what has Wua Brothers' defense been?
Well, they've publicly said that their old fee system was perfectly lawful. They claimed the Fair Trade Commission, the FTC, had actually ruled in their favor on it in the past.
But the story doesn't stop there because Bayman did change its policy back in May. So why is the lawsuit still going forward?
Right, they did change it,
Yeah.
but it's a really technical change, and that's where the dispute is now. The new policy excludes the part of the discount that the store owner themselves pays for, but they still include the portion of the discount that's funded by the franchise headquarters. So the law firm's argument is that a discount is a discount. It doesn't matter who funds it. They're saying the core problem is still there. Owners are paying a commission on money that never actually changed hands, so they plan to sue over the new policy too.
It's just a fascinating, complex fight. It shows you the friction building between platforms and their users as the economy slows down.
Okay, let's pivot now. We're moving from market friction to areas of actual structural change and big government plans. We have two major approvals to talk about. Yeah, starting with the capital markets. The Securities and Futures Commission just approved IMA applications for Korea Investment Securities and Mirai Asset Securities.
IMA, that's the integrated management account.
Right. And you have to understand, this is a huge deal. They are the first new IMA operators to be approved in 8 years.
8 years, that's a long time. What's the significance of bringing this back now, and what does it let them do?
The delay was due to a lot of regulatory issues, but now the government is really pushing to get capital flowing into productive areas. IMA is for the big players firms with over 8 trillion won in capital. It lets them pool client money, but here's the key rule. At least 70% has to be invested in corporate finance assets.
So it's not just another product for saving, it's a tool designed to funnel huge amounts of cash straight into the business world.
Exactly. For the investor, the firm guarantees the principal, so you can chase higher returns without risking your initial investment. But the real policy goal here is the venture capital mandate.
What's that?
IMA operators they are required to allocate 25% of all the money they raise into what's being called adventurous capital, or ANSA.
So venture capital, startups.
Yes. The government is basically forcing this high-quality capital into the startups and high-risk ventures that need it most. And at the same time, Kiwoom Securities got approval to issue short-term notes.
So taken together, it's a really clear signal from regulators. They're trying to activate the capital markets to drive corporate growth.
It's a major push to make sure the financial system can support innovation, even with all the pressure from that double trap we talked about.
Okay, for our last topic, let's go from capital markets to the DMZ. We're seeing this rare, fast-moving, bipartisan agreement on building a renewable energy complex near the border.
This is genuinely remarkable. You've got over 20 lawmakers from the Climate and Energy Committee planning a visit to the border region on November 19th. The political momentum is incredible.
But developing anything near the DMZ is, it's notoriously difficult. What makes this plan actually seem possible?
The breakthrough, and this is everything, hinges on the Ministry of National Defense. They've apparently agreed to shift the civilian control line, the CCL, north by about 5 kilometers. That one move would free up a huge amount of undeveloped land, which they could then immediately use for large-scale solar farms and other renewable projects.
Creating what they're calling a peace and climate energy expressway. It's a huge strategic goal to secure more power for the capital region.
It is, but this is where you have to pause and just look at the political will behind it. The climate minister, Kim Sang-kwon, said the project will be executed immediately, quote, without feasibility studies.
Wow. No feasibility studies.
None. And while that shows just how committed they are, moving forward with a major land use change near the DMZ without that standard due diligence, it does raise some serious questions, about potential costs or unforeseen impacts down the road.
That's a really important point. It's a big risk, but the fact that both parties are willing to skip those steps shows you how badly they want to win on regional development and energy security.
And it's the first big field inspection for this committee since they took over energy policy, so it's a major signal.
So we've come full circle. We started with this immediate market panic over rates and currency, and we're ending with these huge, long-term structural bets on capital markets and new infrastructure. A fascinating contrast. Oh, yeah, I got Yahweh. Yeah, I'm in the sweets here. DMC and the MCR what? What?